This is Kevin Zhao. In this chapter, we'll discuss both passive stock investing and active stock investing in the context of portfolio management. The market risk is the single most important factor for all stock investors, especially in the context of stock portfolio management. It explains more than 98% of value changes in a well-diversified stock portfolio. This is true not only domestically but also internationally as well. To build a stock portfolio, investors need to make two decisions: asset allocation and individual stock selection. Asset allocation is decision on the percentage of portfolio wealth allocated to various asset classes, such as stocks or bonds. It is the main factor in determining the risk and return of the stock portfolio. Passive stock management assumes that the market is efficient, and there is no way to beat the market based on fundamental analysis and active stock trading. The goal of passive stock investing is to match the market performance while minimizing transaction costs. It abandons any attempt to time the market or identify any security mispricing. Once the structure of a passive stock portfolio is established, what investors need to do is hold it with occasional rebalancing and reinvesting any dividend incomes. Index funds follow passive investing strategy by mimicking the structure of market index so that market index performance can be duplicated. Index funds have no intention to find undervalued or overvalued stocks at any given time. It is common for index funds to have a low stock trading turnover and a low operational cost. Due to its low turnover, index funds often have tax advantage compared to actively managed funds. In recent years, many index funds have been transformed into exchange-traded funds, in which shares can be easily traded on the exchange and management fees are reduced significantly for investors. Empirical evidence shows that, on average, index funds do a better job than actively managed funds. Active stock management assumes that the market is not efficient and the stocks are often mispriced. Active stock investors believe that they have superior information, better analytical skills, and ability to do what other investors cannot. However, empirical evidence shows that potential rewards are large as the potential risks for most active stock investors. Traditional strategies for active stock management is to select outperforming stocks. The main focus is the estimation of earnings per share. For investors who prefer value stocks, they seek stocks that are cheap relative to its earnings. For investors who prefer growth stocks, they focus on the expected growth in earnings. Value investing strategy should be built upon a long-term basis by using contrarian approach. Just as Warren Buffett said, be greedy when others are fearful and be fearful when others are greedy. Financial analysts play vital roles in assisting investors for their active stock investing. Their job is to forecast stock returns. There are two types of financial analysts: sell-side analysts and buy-side analysts. Sell-side analysts typically work for stock brokerage firms, and their jobs are to sell brokerage services by providing investing advising services. Their goal is to encourage their clients to trade more based on their stock recommendations. Buy-side analysts work for investment companies or investment banks for their proprietary trading. Their stock researches are only available for their employees, and their goals are to find truly winning stocks. In a typical financial analyst research, stock trading recommendations are stated as either buy or sell or hold, with comprehensive analysis on companies' earnings, target prices, and expected performance. Analysts' recommendations are often revised when fundamentals in a firm changes. Their recommendation change often affect stock prices. For example, when a well-known analyst at UBS downgrades a company's stock rating from buy to hold, stock price will respond negatively. Collectively, sell-side analysts are overly optimistic. At MTSU, students have many resources to get endless stock research. Both S&P Net Advantage and the Value Line Investment Service are available at the library at the Walker's Library. Other well-known investment banks analyst researchers can be found on Bloomberg terminals available on MTSU campus. The graph here shows that on average, financial analysts are overly optimistic. A commonly used strategy for active stock investors is sector rotation. Investors can rotate their stock positions in different sectors based on their expectation of relative performance between different sectors. Sector rotation strategy can be conducted through investment in active sector mutual funds or ETF. Market timing strategy focuses on switch between cash and stock position based on stock market trend forecast. Market timers often shift into cash when stocks expected to do poorly, or shift into stocks when stocks expected to do well. Due to its high trading turnover, high transaction costs, and taxes are expected for market timing strategy. Research suggests that market timing is very risky. As a final note, if the market is efficient, then it is unlikely that active stock investing would be successful. However, the long-term investment performances of great money managers such as Warren Buffett, George Soros, John Paulson, David Einhorn, and so on show that the market may not be that efficient, and active stock investing could be very successful. This is Kevin Zhao. I hope you enjoyed this video, and I will see you in the next class.